Welcome back. Now to our next conversation. Now, the monetary policy meeting ended September's meeting with a hold decision. That means the benchmark interest rate retained at 11.50%. The asymmetric corridor remained at plus 100, minus 700 basis points around the MPR. And the cash reserve ratio retained at 27.50%, and liquidity ratio retained at 30%. Forex management was also a major part of the discourse at the end of the meeting, and we'll delve into some of that with the head of research and strategy with Chapel Hill Denham, Tajuddin Ibrahim. Great to have you on the program. Good morning.
Good morning. Thank you very much for having me.
Yes. So it's another hold decision from the MPC. The reason for this, according to the CBN governor, was not to disrupt the growth trajectory. Is this was this your expectation too?
Yes, it is in line with our expectations, because if we consider the key indicators or factors for consideration, the first of them, I think, is COVID-19. One realizes that we still have, sort of several variants of that pandemic. And if we take a look at vaccination in Nigeria, we are still below the level that we should be. Less than 1% of the entire population is currently vaccinated. So which means that COVID-19 is still a major downside risk to the economy and the country as a whole. The second factor in my mind is what we are seeing on the economic expansion front. In terms of economic growth, the Q2 number shows a recovery, but that recovery is a gradual one. So it makes policy sense, let me put it that way, for the CBN to hold those parameters unchanged. Take a look also at inflation. We noticed that there was moderation in inflation, and that indicates that there is little or no pressure for the Monetary Policy Committee to consider increasing interest rates. And so if we also take a global view at the situation, what we find is that global economies, global central banks are currently normalizing monetary policy, but without necessarily increasing interest rates, particularly in the US, for instance. So the decision of the CBN to hold all those parameters constant is in line with our expectations based on all these indicators that I have talked about.
Inflationary pressure remains mixed. What does this mean in the face of the continuous drop in inflation figures in Nigeria and a lot of views that it's not capturing the reality on ground?
So if we take a look at that statement, one way to understand it is to take a global and also continental view at that statement. Indeed, inflationary pressure is mixed, considering the fact that we have some economies around the world where inflation numbers are higher, and we have some where we are seeing moderation. Let me give you an instance. In the US, for example, the inflation number for the month of August is lower compared to the month of July. But in the UK, they had higher inflation in August, versus the level that they had in July. So in China, they had, lower inflation, in August versus, what they had in July. So it is kind of mixed. And we bear in mind also that we import, from these countries. So whatever happens to, their inflation, is a concern for us, because it speaks to imported inflation into Nigeria. So that is why the CBN, said that, inflationary pressure in those countries are largely mixed. And if we take a look at us in Nigeria here, we are down to 17.01% in August. it sounds positive, but when you take a look at it from a peer comparison perspective, you look at other African countries, you will realize that we are still higher than Kenya, we are still higher than Egypt, we are still higher than Ghana. All these three other countries have inflation numbers that are below 10%. Ours is still 17.01%. We continue to face structural challenges that have not really helped us to have a moderation in inflation that will accommodate the 6 to 9% target of the CBN. So broadly speaking, it is indeed a mixed development in terms of inflationary pressure across the world.
All right, so improvement in the manufacturing and non-manufacturing purchases management index was, applauded, but it remains in negative territory below the 50-point. What does this indicate?
So what it indicates is that we are seeing economic recovery, but it is not as much as we would have loved, for it to be. The momentum is not as strong as for us to say that we are completely out of the woods in terms of economic growth. The PMI, the Purchasing Manager Index, is a leading indicator for people to understand what is happening to the economy. If it is 50 points or above 60 points in particular, then we'll be talking about strong economic expansion. But considering that we have it below 50 points at about 49.6 points as published by the CBN, it means that we are not seeing much economic expansion as we should see, as a country. Even though we had it, improving from the level that, it was, the previous month, we are not there yet in terms of, the expected recovery of the economy. So in the coming months, what we'd expect is that, that indicator should expand further because of the accommodative monetary policy stance of the CBN, the support, from the CBN to businesses and also SMEs in general, and also the fact that we are going to see inflows of US dollars that will allow more businesses that, do business of imports, to have access to US dollars and do their business. So on the back of all those, we should see better PMI numbers in the coming months, in my view.
Okay, so foreign exchange management has been described as the big elephant in the room in recent times. The CBN governor has affirmed the determination of the regulator to continue in its line of action to cleanse the space of illegal dealers. But analysts say the issue of pricing and supply are core to solving this challenge and not about, like stopping supply to BDCs and all that. What's your view on how to solve this FX problem?
I think we should take a two-way view at that issue. The first is, let's take a short-term look at it. In the short term, one can easily argue that, all that we need in that market is increased liquidity, and that should, to some extent, support the stability of the currency. But at some point, we will still run into trouble because our FX reserves are going to go down on the back of supply, by the CBN. So at that point, what do we do again? So do we allow the currency to, depreciate or devalue again? I think the answer is no. And this is what will bring me to our long-term view in terms of what can we do to the currency. And what I strongly believe we can do is to ensure that, we put in place the required strategies that will allow the country to produce more, and then we have, increased consumption of locally made goods and services. By the time we have that, import will reduce substantially. By the time we have that, there will be little or no need to speculate on the currency, because what you need, you can get in the country. And I believe that this will be a long-term play, and we cannot fix this until we fix our infrastructure challenges. And I'm very happy to say that the government is on the right track in terms of fixing these challenges, as we now have what is now called the Infraco, which is going to address the majority of our infrastructure problems. If we fix all these problems, then we will eventually fix our FX challenges for the long term, and we will continue to see stability on the of the naira, as we see it in global economies like the US, like the UK, and even the UAE, for instance. So you wouldn't see enormous volatility in their currencies in those countries. It is because they have the right structure. Nigeria can do it, and I strongly believe
just before we let you go, I know you talked about Infraco, which I think have been launched this week or something. What about the short term? Is there anything that can be done in the short term? Because when you talk about infrastructure, those are long-term solutions.
So in the short term, I said what we need is for us to have increased liquidity, and that liquidity is going to come from, number one, the inflows that the CBN is getting. They got $3.34 billion or thereabouts from the SDR, and we are in the market as we speak. The government is in the market.
I think we lost Tajuddin there. It would be nice to know what he thinks we can do it in the short term, because, I mean, at this rate, we need to do something fast before infrastructure gets in place. But anyway, thank you so much. That was Tajuddin Ibrahim, Head of Research and Strategy with Chapel Hill Denham, sharing his thoughts. Okay, are you back, Tajuddin? Okay, could you just finish up your thoughts?
Okay, so yes, I said that the CBN is now better, equipped to supply liquidity to the markets, because they have $3.3 billion SDR inflow. We are in the markets to issue Eurobond about $3 billion. That speaks to a total of $6 billion. And they have indicated on Friday on a call that they'll probably do $6 billion if the market is that robust. So in essence, we are expecting between $6 to $9 billion inflow to the CBN or to the country from the next couple of days. And what that means is that the CBN is better positioned to supply liquidity to the market, and that should result in stability in the FX rate in the market. That is the short-term solution in my view.
All right, okay. Well, we're counting down to days to see the effect of that. Thank you so much, Tajuddin Ibrahim, Head of Research and Strategy with Chapel Hill Denham, and enjoy the rest of your day.
You too.